Hello, good afternoon and welcome to World Economy. My name is Blyden Ukem. On World Economy today, a UN chief gives urgent climate warning as El Niño approaches. We begin from there. UN Secretary General Antonio Guterres has issued an urgent climate warning, citing a new World Meteorological Organization update that places the likelihood of El Niño arriving in the coming months at 90%. Let's find out more from the UN Secretary General Antonio Guterres.
Meteorological Organization for this vital new update. The science is clear. El Niño is arriving on our doorstep in the coming months with 90% certainty. The world must treat it as the urgent climate warning it is. El Niño conditions will pour fuel on the fire of a warming world. Impacts will hit even harder, travel even further, and cross borders with devastating speed. The only effective response is climate action equal to the crisis, ending the addiction to fossil fuels, accelerating the shift to renewables, protecting the most vulnerable, and delivering early warning systems for all.
El Niño brings several localized and global impacts to regions in the coming months. With the World Meteorological Organization forecasting a 90% likelihood of a moderate to strong El Niño event by November, this climate pattern is accelerating global temperature increases and supercharging extreme weather across the globe. The arrival of El Niño brings several localized and global impacts to regions in the coming month. Now looking at the global temperatures. A downpour of fuel on an already warming climate, driving above average temperatures nearly everywhere. This threatens to make the coming years the hottest on record. Drought and wildfire. A dry, hotter condition will likely hit Australia, Central America, the Amazon, and parts of South Asia and Sub-Saharan Africa, heightening risks for severe wildfire and agricultural stress. Heavy rainfall and floods often triggers higher than average precipitation and devastating floods in Southeast Asia, part of East Africa, and the southern US. Hurricane activity will be part of El Niño, as it tends to suppress tropical storm formation in the Atlantic Basin, but fuels more intense hurricane activity in the Central and Eastern Pacific regions. Food and health hazard. Cascading impact will threaten public health, example heat stress, water shortages, and put serious pressure on the global agricultural sector and local food security. The Organization for Economic Cooperation and Development, OECD, lowered its global growth forecast for this year to 2.8% from 3.4%, while keeping the projection for 2027 steady at 3.1%. The agency noted that the duration and extent of the conflict in the Middle East remain uncertain, but the economic effects are likely to be felt for some time, given the months it will take to restore damaged infrastructure and transport routes and deliver products around the world. A growth is set to slow modestly in North America and Europe before a tentative recovery, with the US easing to 2% in 2026 and 1.8% in 2027, Canada dipping to 1.2% before rebounding to 1.7%, Mexico strengthening to 1.9% by 2027, the UK from 0.9% to 1.1%, while China moderates steadily to 4.5% in 2026 and 4.3% in 2027. In addition, the OECD noted that higher energy prices, supply shortages, tighter financial conditions, and weaker confidence would weigh on activity worldwide. Inflation would also intensify, rising by around 0.4 percentage points in 2026 and 1.3 percentage points in 2027. And now let's look at military spending by country in 2025. Global military spending reached nearly $2.9 trillion in 2025, but spending remained heavily concentrated among the handful of countries. As the graphics we're about to show, the United States, China, and Russia alone accounted for more than half of global military expenditure in 2025. The data is from the SIPRI, a military expenditure database which tracks military spending across countries worldwide. The United States maintained an unmatched lead. The United States accounted for roughly 1/3 of all military spending worldwide in 2025, giving it by far the largest defense budget of any country. No other nation accounted for even 12% of global military spending, highlighting the scale of America's lead. Let's look at the charts. The scale of U.S. spending reflects its extensive global military presence, advanced weapon programs, and network of alliances spanning Europe, Asia, and the Middle East. Now let's look at the charts indicating military spending by country in 2025. China remains the world's second largest military spender at approximately $336 billion. While still by far are below U.S. levels, China's defense budget has grown steadily over the past 2 decades as the country expands its military capabilities and regional influence. Meanwhile, Europe moves up the ranking. Germany, the United Kingdom, Ukraine, France, Italy, Poland, and Spain all ranked among the world's largest military spenders in 2025. The concentration of European countries near the top of the list reflects the continent's continued push to strengthen military readiness following Russia's invasion of Ukraine. Ukraine ranks 7th globally with military spending of roughly $84 billion as a result of ongoing conflicts with Russia. Meanwhile, Poland has emerged as one of Europe's fastest growing defense spenders as it accelerates military modernization efforts. In Asia, several Asia-Pacific nations also ranked among the world's largest military spenders. India, Japan, South Korea, Australia, Taiwan, Singapore have all increased defense expenditures in recent years as regional competition intensifies. India's military budget surpassed $92 billion, making it the 5th largest spender globally. Meanwhile, Japan's spending exceeded $62 billion as the country continues implementing its largest military buildup since World War II. And now to the market as oil prices rise for 3rd session. Oil prices rose by more than 2%, with WTI approaching $96 per barrel and Brent holding near $98 amid escalating tensions in the Middle East. The U.S. Central Command said U.S. forces downed Iranian missiles and drones and struck Al-Qassim Island in self-defense following Iranian attacks across the Middle East. And now let's go to the markets, the commodity markets. Let's look at the prices of commodities. First, starting with the price of copper. Copper price at $6.5 per pound, moving quickly to the price of crude oil as U.S. crude price level stands at $96 per barrel, upward by 2.552 points, a 2.72% appreciation. Brent price, which represents Nigeria's price benchmark, Brent price stands at $98 per barrel, upward by 2.279 points, a 2.37% appreciation. Natural gas falling this morning, gasoline gaining 1.24%, heating oil gaining 3.53%, and the price of gold is at $4,454 per ounce, downward by 36 points this morning. The price of copper a downward 1.58%. Soybean price at $1,171 per bushel, gaining 6 points, 0.55%, with price upward, coal price upward, steel price dropping at $3,177 per pound, dropping rather Chinese yuan per pound, dropping by 13 points, negative 0.41% decline. Meanwhile, the U.S. announces new tariff over forced labor concerns. The U.S. has announced new tariff of 10 to 12.5% on dozens of countries, accounting for almost all its import over concerns they are not doing enough to tackle forced labor. It is the second time President Donald Trump's administration has announced new import taxes since the U.S. Supreme Court struck down many of its previous duties in February. The U.S. Trade Department said these countries will face tariffs because of their failure to address the importing of goods made with forced labor. The UK said it is tackling forced labor, China denied goods are made with forced labor, and the EU said the tariffs were unjustified. Meanwhile, an India analyst has said the move was a pressure tactic. The 60 trading partners listed, including the UK, the EU, Canada, India, and Japan, account for almost all the goods sold to the US. He said 6 other trading partners, Canada, the EU, Ecuador, Indonesia, Mexico, and Pakistan, had failed to effectively enforce a forced labor import prohibition. The Trade Department said it would impose 10% tariff on import from Canada, the EU, Britain, Indonesia, Mexico, Pakistan, Argentina, Bangladesh, Cambodia, El Salvador, Guatemala, Indonesia, Malaysia, and Taiwan. The remaining 45 countries, which include China and India, would face 12.5% duties. And now we'll go on a quick break, and when we're back, world economy continues. We'll be looking at who controls the world's uranium supply. Don't go anywhere. We'll be right back. Welcome back. It's your world economy, and my name is Blyden Kim. The big question being asked around the world amid electricity concern around the world, also amid the war, is who controls the world's uranium supply? We'll get to detail of it. Nuclear power is regaining momentum as countries seek stable electricity supplies and lower carbon energy sources. That has pushed uranium, the fuel used in nuclear reactors, back into focus. This data is from the World Nuclear Association showing annual uranium production by country from 2015 to 2024. Kazakhstan remains the dominant supplier by a wide margin, while countries like Canada and Namibia have rapidly expanded production in recent years. And now let's look at the charts indicating who controls the world's uranium supply. The country combines large sandstone uranium deposits with low cost in C2 recovery mining techniques, which are generally cheaper and less labor intensive than conventional mining. Kazakhstan also ranks as second globally in uranium reserves. While Kazakhstan output dipped during the pandemic years, production rebounded strongly by 2024 as uranium demand and price recovered. Canada ranked as the world's second largest uranium producer in 2024, with output rising to 14,309 tons. Production had previously collapsed in 2020 due to mine shutdown and weak market conditions, but a restart of major projects such as Cedar Lake and MacArthur River helped drive a sharp recovery. Namibia also strengthened its position as a major supplier, producing 7,333 tons in 2024. The country has emerged as one of the fastest growing uranium suppliers in the world, supported by large open pit mines and rising foreign investment tied to growing nuclear fuel demand. Meanwhile, US uranium production nearly disappeared in 2020, falling to just 6 tons as low prices made domestic mining uneconomical. However, the sector has started recovering amid high uranium prices and geopolitical concerns surrounding global supply chains. Restrictions on Russian uranium imports have also increased interest in rebuilding domestic production capacity. Even after rebounding from near zero production in 2020, the US produced just 260 tons of uranium in 2024 versus more than 23,000 tons in Kazakhstan. The gap highlights how dependent global nuclear fuel markets remain on a small number of suppliers. And back to Africa, as Ghana inflation rate is up to 4-month high in May. Ghana's annual inflation rate accelerated for a second month to 3.7% in May 2026 from 3.4% in April, reaching its highest level since January. Food and non-alcoholic beverages inflation rose to 3.3% from 2.2%, driving the increase as higher oil and fertilizer costs are linked to the Middle East war and ongoing effects of climate change weighed on domestic agricultural activity. Meanwhile, non-food inflation edged down slightly to 4.1% from 4.2%. On a monthly basis, the consumer price index rose by 1.1% in May, up from 1% in the prior month. And our last look at the charts indicating Ghana's inflation rate. the charts indicating Ghana's inflation rates. And now looking at the charts indicating Ghana's inflation rate. At the peak of it last year, May, chart numbers was at about 16.4% and began to slow down to 12% in July last year. Went even further to 9.4% in September and dropped to 6.3% in November. At a statutory point of 3.8% in January 2026, began to be very stable at 3.3% and 3.2% in March. But a slight increment looking at Ghana's inflation representing the cost of commodities increasing, or rather the price of commodities increasing, as well as a slight weakness in Ghanaian cedi. Straight back to the markets as European shares are lower. The European stocks traded lower on Wednesday today, with a Stock of 50 declining 0.4% and a Stock 600 slipping 0.2%, as rising oil prices and renewed uncertainty in the Middle East weigh on investor sentiments. Concerns were also fueled by fresh tariffs announced by President Donald Trump. The Office of the U.S. Trade Representative has proposed additional tariff of up to 12.5% on 60 trading partners over the alleged failure to prohibit goods produced with forced labor, including the EU, China, and Japan. Energy price-sensitive airlines came under pressure, with Lufthansa and Air France both falling around 1%. Automakers were also lower, including Mercedes-Benz, a negative 2.1%, and BMW, a negative 2.4%. In addition, the banking sector came under pressure, with stocks falling for HSBC Holdings, a negative 1.2%, BBVA, a negative 1%, and Intesa Sanpaolo, a negative 0.9%. In contrast, retail stocks outperformed, led by Inditex, whose shares jumped 4.6% after the company reported a 5.4% increase in the first quarter profit. And now let's look at global company stocks. Global company stocks begin with a stock price of Apple company at $314 per share. Apple falling 1.13 points, a negative 0.36% decline. Tesla at $419 per share, a downward by 4.27 points, a negative 1.01% decline. And Microsoft at $439 per share, also downward, negative 0.34% decline. Amazon dropping a negative 0.45%, Meta at $600 per share, gaining 3.16 points, a 0.53% appreciation. Nvidia at $222 per share, a downward, a negative 0.1% decline. Looking at other companies, global company stocks, JP Morgan at $300 per share, gaining 4 points this afternoon, a 1.48% appreciation. Oracle dropping a negative 0.99% decline. P&G at $140 per share, gaining 0.39%. ExxonMobil gaining 0.12%. Alphabet a negative 3.86% decline. And Goldman Sachs at $1,064 per share, gaining 16 points, 1.53% appreciation. And finally, on world economy today, Uganda is making it harder to use cash as digital payment tops $100 billion. Uganda is taking one of its boldest steps yet towards a cashless economy, introducing strict limits on cash withdrawal and check transaction as digital payments in the country surpass $100.3 billion a year. The move follows a surge in digital payment and mobile money transactions, which now exceed $100 billion annually. Authorities say the measures will promote a more transparent, digital-first financial system and reduce reliance on cash. However, challenges remain for rural communities and informal businesses that still depend heavily on physical currency. First, let's look at the FX market as we close. FX markets. FX market indicates the price of currencies around the world. The euro against the US dollar, a price level standing at $1.15 equaling €1. The euro dropping a negative 0.28% against the dollar. The pound against the US dollar, price level at $1.34. The pound also falling against the US dollar, negative 0.27% decline. Australian dollar struggling against the US dollar. New Zealand dollar also struggling against the US dollar. But the US dollar against the Japanese yen, price level standing at 159 yen, equaling 1 US dollar. No significant change in that market. Volatility of this market has been slightly low. Still looking at the FX market, the US dollar against the Swiss franc, price level standing at 0.79 franc, equaling 1 US dollar. Again for the US dollar, a 0.36% gain. The US dollar against the Canadian dollar, a price level standing at 1.38 Canadian dollar against the US dollar, the dollar gaining 0.19%. The US dollar against the Mexican peso, the peso stands at 17.3 peso, equaling 1 US dollar, the dollar gaining 0.12%. The US dollar against the Indian rupee, the rupee stands at 95 rupee to 1 US dollar, the dollar gaining 0.33%. The US dollar against the Brazilian real, the real at 5.03 real, equaling 1 US dollar, the dollar gaining 0.26% appreciation over the Brazilian real. And the US dollar against the Russian ruble. The Russian ruble price level stands at 73 ruble, equaling 1 US dollar. The dollar gaining 1.29% appreciation over the ruble. And the South Korean won against the US dollar. US dollar against the South Korean won, indicating 1,526 won, equaling 1 US dollar. A 9-point gain for the dollar. A 0.6% appreciation. And the US dollar index price level standing at 99 index points, gaining a 0.25% appreciation. So the US dollar is doing quite well in the afternoon compared to the rest of the majors and international currencies around the world. But it is what it is when it has to do with world economy. And here we draw the curtain in today's edition of World Economy. Thank you for being a part of it. My name is Blyden Lukem, and thank you for watching.